And this is Bloomberg Technology. Coming up in the next hour, Amazon in the sights of EU antitrust investigators. Will the retail giant follow in Google's footsteps and face a probe? Plus, Jeff Bezos in an extensive interview about the company he founded and why he doesn't take meetings before 10 a.m. And homeware retailers caught up in tech's retail disruption. We will hear from Cretan CEO Neela Montgomery on how the company is using social media to boost engagement. But first to our top story. Amazon is in the sights of the European Union's antitrust investigators. The EU is now looking at how the online retail giant collects and uses data from other retailers who sell on its platform, and specifically whether the data gives Amazon an unfair advantage. For more, we're going to Brussels and our Bloomberg Tech reporter, Natalia Drozdiak. Talk to us about what exactly the EU is looking at here.
Yeah, so they said it's still very early days, but they said, of particular concern is whether they're looking at Amazon's dual role both as a platform and a merchant in its own right. So the question is whether they might have access to data or information about customers and sales as their role as a platform that could give them an advantage as a merchant and better competing with those competitors.
Now, EU antitrust regulators have looked at Amazon before. What did they look at previously, and what did they find?
Yeah, so they have looked at Amazon in the past, but the company was able to escape relatively unscathed. In 2016, the company escaped being fined by settling on an investigation into their ebook service. And then last year, they were also ordered by the EU to pay back 250 million euros in allegedly unpaid taxes. But that, is a drop in the bucket compared to what the EU asked Apple to pay back, which was 13 billion euros.
You mentioned Apple, and of course, we've also talked about Alphabet. The EU has been very aggressive in pursuing big tech. What is the likelihood that this does result in a formal probe?
Yeah. I mean, the EU has, I think it's fair to say, is the most aggressive regulator when it comes to regulating big tech. I mean, Silicon Valley is getting used to, or getting to know the EU antitrust chief, Margrethe Vestager, quite well. The most recent example of one of their decisions was in July when they fined Google a €1 billion fine for the second record fine in less than a year. So, there are questions that this is just the beginning for Amazon, and they could in fact be next.
Walk us through the timeline here. When will we know more?
So, as I said, it's still a preliminary probe. So they're just in the process of asking questions at the moment. So they sent out questionnaires to other companies and retailers to kind of gather more information. And then if they see deeper concerns, then they might open what's called, a formal probe. And that is, that's when it would kind of pick up at a faster pace. But these investigations do take a long time. I mean, they can take years. As Google knows, this has been going on for almost 10 years since they started the preliminary probe into Google over its behavior. So it can take a long time, but the signs are definitely pointing in that direction. So
now, interestingly, Amazon is one of the companies that President Trump has attacked, clearly has his eye on it. We have this question about whether this will result or lead to some kind of antitrust suit here in the United States. I mean, how much have the steps in Europe really impacted the steps that we're seeing being taken by regulators in the rest of the world when it comes to big tech?
Yeah, I mean, I think it's fair to say that the EU has played a significant role in influencing other jurisdictions around the world in terms of regulating big tech. I mean, I would say that there is a difference in the EU versus the US. The EU can move a lot quicker with these antitrust investigations versus the US, and that's partly because of the way the system is set up. The EU can take these unilateral decisions, whereas in the U.S. authorities have to prove their court and case. They have to prove their case in court first before they can move ahead. So while there has been a lot of debate in the U.S. as well about the role of Amazon and Google and Facebook as well, it could take even longer before we see significant action there.
Now, say this does progress, is a fine the ultimate punishment, or is it actually changing business practices?
Yeah, so, in an antitrust investigation, the EU has the power to fine companies as much as 10% of its annual revenue. And I mean, in Google in Google's case, for instance, that actually does amount to quite a lot. But more significantly for these companies, the EU regulators usually ask them to, or order them, I should say, to change their behavior. And this move to open an initial probe into Amazon's behavior really suggests that the EU is taking issue with platforms and the way they treat other rivals that operate on those platforms. So that is a bit of a shift, and and we've seen in the Google case that they're starting to ask platforms to treat those other competitors equally, despite the fact that those competitors are using the platforms to extend their own reach.
All right, Bloomberg Tech's Natalia Drozdiak in Brussels. I know this is one you'll continue to follow for us. Thank you very much. Meantime, Amazon founder, chair, and CEO Jeff Bezos rarely speaks to the press, but sat down with David Rubenstein for a wide-ranging conversation about the company and his philosophy on management. Take a listen.
You sit around with your team and so forth, but you don't like meetings before 10 a.m.
No.
You like to get 8 hours of sleep, and you don't like PowerPoints. Explain all that. Why is that?
Okay, so I like to putter in the morning. I get up early. I go to bed early. I get up early. I like to putter in the mornings. I like to read the newspaper. I like to have coffee. I like to have breakfast with my kids before they go to school. So I have my kind of puttering time is very important to me. And so that's why I set my first meeting for 10 o'clock. I like to do my high IQ meetings before lunch. Like anything that's going to be really mentally challenging, that's a 10 o'clock meeting. And because by 5 p.m., I'm like, I can't think about that today. Let's try this again tomorrow at 10 a.m. And so then on sleep, I get 8 hours of sleep. I prioritize it, unless I'm traveling in different time zones. Sometimes it's impossible, but I am very focused on it. And for me, I need 8 hours of sleep. I think better. I have more energy. My mood is better. All these things. And think about it. As a senior executive, what do you really get paid to do? As a senior executive, you get paid to make a small number of high-quality decisions. Your job is not to make thousands of decisions every day. Is that really worth it if the quality of those decisions might be lower because you're tired or grouchy or any number of things? Now, it's different if it's a startup company. I mean, you're really, when Amazon was 100 people, it's a different story, but Amazon's not a startup company, and all of our senior executives operate the same way I do. They work in the future, they live in the future. None of the people who report to me should really be focused on the current quarter. I always tell people, sometimes we'll have a good quarterly conference call or something, and Wall Street will like our quarterly results, and people will stop me and say, congratulations on your quarter, and I say, thank you. But what I'm really thinking is, that quarter was baked 3 years ago. Right now, I'm working on a quarter that's going to reveal itself in 2021 sometime. And that's what you need to be doing. You need to be out sort of, 2 or 3 years in advance. And and then why do I need to make 100 decisions today? If I make like 3 good decisions a day, that's enough. and they should just be as high quality as I can make them.
Amazon Chair, CEO, and founder Jeff Bezos with David Rubenstein at the Economic Club in Washington. You can see more of that interview on the David Rubenstein Show on Bloomberg Television. We'll have a bit more later in our show as well. Still ahead, our exclusive conversation with the CEO of Cretan Barrel, how Neela Montgomery is leveraging technology to keep the clothing company relevant. And if you like Bloomberg News, check us out on the radio. Listen on the Bloomberg app, Bloomberg.com, and in the U.S. on SiriusXM. This is Bloomberg. As more retail shifts online, one of the fastest growing segments is homewares. Wayfair says the e-commerce furnishings market is growing about 15% annually, meaning traditional retailers like Cretan Barrel have to adapt. In the first interview of a new series on retail disruption, Bloomberg's Emma Chandra spoke with Cretan Barrel CEO Neela Montgomery and started by asking how social media is changing the way customers engage with the brand.
Well, I think all retailers at the moment, especially one like ours that's got a 56-year-old heritage, have to transform for the digital era. We know that our customers increasingly interact with us across different channels and across social media, etc. And so one of the things that I have really driven as an agenda is ensuring that our brand is delivered consistently, whether it's on Instagram or through Pinterest or through digital services such as Zni, which offers online design services, and 3D visualization. So our customers are changing, we need to change, and so technology's been a big driver since I've been here.
And social media, it sounds like you've embraced it.
Yes, very much so, because we know that home is a category that customers love. There's more interest than ever in design and interior design, and our customers everyone's an amateur designer these days, and that's great. We can embrace that for the new era.
So let's stick for a moment with your consumer moving online. You try and reach them online in terms of advertising, and then how are you serving them online? Has your e-commerce business grown in the same way as your advertising business has?
It has. So over 50% of our advertising these days is online, which is a shift from even just 2 years ago. But also our e-commerce sales are 47%, which typically surprises people, but it's actually not bad.
You wouldn't expect that for large goods like furniture.
Exactly. And it shows just how comfortable customers have become. Now, typically that tends to be higher with established brands that they trust. They know Cretan Barrel, they trust us for our quality. But 47% is a high growth number.
And are you expecting it to go higher?
I am. I don't really know where it will top out, maybe 50, maybe 60%. I expect it won't go higher than that because there will always be a customer who either has a convenience purchase they're making in the store or somebody who really wants something today.
You mentioned a little bit about leveraging technology as well. How is data, AI, those sorts of areas of the business, how are they helping you make business decisions when it comes to Cretan Barrel?
Yeah, good question. And it's I think that's probably the most exciting part of our business right now. It sounds a bit geeky, but the reality is we are able to leverage customer data in a way that we just were never able to do so before. So one of the things we talk a lot about is one customer view, being able to really map all the different interactions we have with customers and offer them a highly personalized experience, whether it's online or by email. And I think customers increasingly expect that from us, or including in our design studio. You know, when someone comes for an in-house consultation, our design expert can see, you know, what are their tastes, what have they bought before, what is their browsing behavior. That is hugely important in us offering the kind of absolute pinnacle of customer service.
And does this differentiate you from the competition? Because the competitive landscape for Crate & Barrel has changed somewhat. You obviously have the likes of Williams-Sonoma, Pier 1, but now there's also Amazon Home, Wayfair, Walmart and Target have big home departments, and they're also increasing their e-commerce offerings. How do you, or how does Crate & Barrel fit into that landscape?
All competition, I think, is a good thing, and the home industry is growing really well, and I think that customers increasingly have choices. They mix and match their products and their rooms. But what we find, and we've had very healthy growth over the last couple of years.
What kind of growth?
We don't publish our growth figures, but I can say to you they're kind of in the mid to high single digits. Last year was 8%. So, you know, we're happy with that level of growth. And what we're seeing is that customers come to us because they expect a certain level of service.
That was Crate & Barrel CEO Neela Montgomery speaking with Bloomberg's Emma Chandra. We will continue our look at tech disrupting the retail world when we speak to the CEO of J.Crew, Jim Brett. Coming up, AMC wants to keep The Walking Dead on its feet. How the network plans to expand the series further to keep up with competitors next. And Bloomberg Technology is live streaming on Twitter. Check us out at Technology and be sure to follow our global breaking news network, TikTok, on Twitter. This is Bloomberg. AMC wants to keep The Walking Dead alive. As the zombie apocalypse show enters its 9th season, AMC is planning to produce several movie and TV spin-offs to keep the series going for another 10 years. The series is the latest to expand into a franchise following the likes of Disney's Marvel, Star Wars universes, and this is, of course, as TV is competing for attention with mobile apps, video games, and online series. Could a franchise help AMC keep up as competing networks and streaming services like Netflix and Hulu bring more and more original content to the scene? Here to discuss, Bloomberg's Lucas Shaw. So Lucas, is it a smart strategy to double down on something that is working rather than trying to come up with new original content like Netflix and others are doing?
You know, it may be the only option they have at this moment, just because if you look across the AMC universe, it is so far and away their most popular show. Even though the viewership for The Walking Dead has fallen over the past few years, you know, I think the most recent season it was the 3rd or 4th most popular show among that 18 to 49 demographic that advertisers really care about. And at the same time that they put out this new universe with different movies and different shows, they will try to find that next original hit. But they can't take as many swings as Netflix is going to, so they have to try to lean on something that they know works for the time being.
Well, you know, I think I was one of those Walking Dead viewers that was watching at the peak, and I don't watch it anymore. Is there a risk in overextending the franchise and then it falling flat?
There's absolutely a risk in that. I mean, most of the sentiment that I saw on social media this morning was negative. That's anecdotal, but it's probably not a great sign. And Fear the Walking Dead, which is the prequel that they came up with, that's now in its 3rd or 4th season, the viewership for that show is much smaller than The Walking Dead. So that's one of the reasons why you may see AMC enlist a third party, another big media company, to help them, both to kind of reduce some of that risk and to help kind of give it a fresh spin, maybe amplify the message. If they were to partner with Disney, Comcast, Netflix, Amazon, somebody like that, it could generate a little more excitement.
I'm thinking about other shows that are ending on a high note, like Game of Thrones. You know, why aren't we seeing this strategy elsewhere?
Well, with Game of Thrones, HBO is developing a bunch of different prequels. George R.R. Martin, who wrote the books that the show is based on, talked about it at the Emmy Awards on Monday night. They're probably only going to make one of them, but HBO will try to do something similar, I'd imagine, with Game of Thrones that AMC is doing with Walking Dead, because if you have a franchise that is so popular, why are you going to let it die, especially when you've seen Disney have such success with Marvel, with Star Wars, with others? Now, to your point about overextension, people are probably going to get tired of some of these. And some of the early efforts at creating these universes haven't been that successful. Universal Pictures tried it with some monster movies, hasn't worked that well. Paramount Pictures is trying it with Transformers, and we'll get a test of whether that's going to work with this movie Bumblebee in December. But you have to, I think if you're one of these big companies and you're nervous about who's going to keep coming in, who's going to sign up for your app, you're going to try to turn one of your most valuable properties into something even more.
Meantime, Netflix took home 23 Emmys. That was the tops. Can these other networks and streaming services really continue to compete with the billions and billions and billions of dollars that Netflix is investing?
Well, they can if they're big enough. So the Disneys of the world, the Comcasts of the world, the AT&Ts of the world, which it now owns Time Warner, they have the money to compete. It's a question of how much they want to spend and do they want to go head to head. AMC comparatively is much smaller. So on a project by project basis, AMC is probably not able to spend quite as much as Netflix. But we're seeing a lot of these studios and networks adjust the way that they approach talent, which, sorry for being a tease, is the subject of a story I'm doing in a little bit.
Well, look, it's been done before. I believe ABC's Bachelor has been on for almost 20 years. But how much longer does AMC think it can keep Walking Dead alive?
Look, Josh Sapan, who's the CEO, very smart guy, said that they're going to try to keep it alive for at least 10 years. The sources that I spoke with about the plans, because Sapan didn't go into a tremendous amount of detail at this investor conference, said that the plan is to have at least a couple movies, many which could lead into series. That stretches. Walking Dead is now 8 years. If these have any kind of success, that could be 5, 6, 7 years for each series.
All right, Bloomberg's Lucas Shaw for us down in LA. Thanks so much, Lucas, as always. Well, Bloomberg has learned that the long battle for control of the UK Sky satellite broadcaster may be settled in an abbreviated auction starting Saturday. The two bidders would be Comcast and 21st Century Fox. Disney has already beaten out Comcast to buy most of Fox's entertainment assets, including its 39% stake in Sky. So if Fox is the winning bidder, Disney would get control of Sky. Ford and Volkswagen will face more competition in the race to roll out self-driving cars. Now, one of the world's largest auto parts suppliers is joining in. Germany's ZF Friedrichshafen plans to invest $14 billion over the next 5 years on electric and autonomous vehicle technology. That includes building a battery-powered delivery van that can drive on its own. And take a look at this. Renault's new concept design for an autonomous car may remind you of something in your daily life and then make you wonder why. Inspiration for the EZ Pro came from, of all places, a lunchbox, which is fitting as the driverless car is designed at making deliveries from food to parcels faster and cheaper. It's slated to hit the road around 2030, and while the 16-foot-long gray robot with wheels won't need a driver, it'll have a concierge on board to help with the logistics of delivering online orders. Coming up, more of Jeff Bezos, Amazon everything. That's next. This is Bloomberg. I'm Emily Chang, and this is Bloomberg Technology. Well, it's probably safe to say that Amazon, only the second U.S. publicly traded company to cross that $1 trillion mark, would have never hit that milestone if it kept selling just books. So, just how did Jeff Bezos' creation get so big? Take a listen to his explanation in this interview with David Rubenstein.
So, what propelled you to sell things more than books?
After books, we started selling music. And then we started selling videos. And then I got smart and I emailed 1,000 randomly selected customers and asked them, besides the things we sell today, what would you like to see us sell? And that answer came back incredibly long-tailed. The way they answered the question was with whatever they were looking for at that moment. So I remember one of the answers was, I wish you sold windshield wiper blades because I really need windshield wiper blades. And I thought to myself, we can sell anything this way. And then we launched electronics and toys and many other categories over time. And the vision became, because you read the original business plan, it's just books.
Your stock at one point, I think, went to $100, but then it went down to $6 or something like that.
At the peak of the internet bubble, our stock peaked somewhere around $113. Okay. And then after the internet bubble busted open, our stock went down to 6. It went from 113 to 6 in less than a year. So my annual shareholder that year starts with a one-word sentence, and that one-word sentence is the word ouch.
So most of those internet companies of the dot-com era are out of business.
Yeah.
You survived. What was it that made you to survive, and virtually the rest of them are gone?
That whole period is very interesting because the stock is not the company, and the company is not the stock. And so as I watched the stock fall from 113 to 6, I was also watching all of our internal business metrics, number of customers, profit per unit, everything you can imagine, defects, etc. Every single thing about the business was getting better.
So selling pretty much anything you can think of has another massive benefit for Amazon, in addition to the share price. Its advertising business is gaining faster than expected in a market dominated by Facebook and Google. The world's biggest online retailer will generate $4.61 billion in U.S. ad sales this year. That translates to 4.2% of the total digital ad market. To discuss, we've got Bloomberg's Spencer Soper in Seattle, who covers Amazon for us, and here in the studio with me, Darren Baker, CEO of JumpShot, a market analytics company that tracks up to 5 billion clicks a day on over 100 million devices to deliver insights on online customer behavior. So Darren, what do you think led to this surge in ad sales?
I think it's really fascinating. So we have seen a shift from Google to Amazon. Today, over 54% of all the product searches that occur on the entire internet now occur on Amazon. And once you get into Amazon, we've seen a strong growth in the number of sponsored placements that they put on their site. The product views that emanated from a sponsored click has increased from 3% to 7% in the last 18 months. And you can see the revenue that Bloomberg reported today as a direct result of that.
So that's not great for Google. Do you see Amazon taking share from Google, or is the pie getting bigger?
No, I think the two are converging. I think it's actually really interesting. So you see Amazon, we did some additional analysis at JumpShot that showed that from the time a consumer searches on either Google or Amazon to the time that they buy was actually much shorter on Google. 35% of those purchases were made within 5 days on Google, only 20% in Amazon. So I think what you're seeing is Amazon is becoming a place for product discovery for customers more, and Google is shifting from pure product discovery to more of that considered purchase. When people are interested in understanding the price or the quality or the brand name, they're going away from Amazon back to Google now.
Spencer, how much of a threat is this to Facebook, which is really in the number 2 position?
Yeah, it's definitely a threat. The big thing that advertisers want is that proximity to the purchase and that tracking, knowing, okay, if someone saw this on Amazon, are they getting it? Whereas Facebook would be seen more broadly as like kind of the brand awareness, kind of like the digital equivalent of the billboard you pass on the highway. But a big thing of Amazon that your other guest just mentioned is everyone's heard of showrooming, this notion of you go to a store, try something out, you like it, then you find it on Amazon and buy it there because you get a better price. Another phenomenon that's contributing to this advertising business is actually reverse showrooming. You need a product, you go to the store, you want to buy it, it's right there, you can pick it up at Target or Walmart, you just want to learn a little bit more about it, you might search on Amazon before making that purchase. And that's where Amazon's search engine is actually driving these purchases, not even just on Amazon, but even in the stores of its competitors.
Darren, what are some more specific trends within the product searching that you're seeing that might be surprising?
Yeah, so it's fascinating. So we gave you that 54% of searches occur on Amazon. Once you get to Amazon, 90% of the product views actually are the result of a search. So people aren't messing around with merchandising placements or banner ads. They are typing a search for a product into Amazon and getting a search result. And once they get that search result, we found that over 2/3 of the clicks are on the first page. So imagine if you're a brand, you know that the majority of your customers are now searching for your product on Amazon. You know that once people get to Amazon, the only thing they're doing is typing in a product search, really. And then once you get that search result, you've got your competitors' products, you've got Amazon's private label products. You have to decide whether you're going to try to increase your organic results or pay for a sponsored placement. It's a very confusing world for a brand today.
Now, Spencer, we talk so much about privacy with respect to Google and Facebook, but now we have EU regulators looking into the data that Amazon is collecting from other retailers on its platform and whether that gives Amazon an unfair advantage, an unfair view into shopping habits. How serious do you think this is?
Well, I think it's very serious, and especially Amazon really doesn't want anybody looking under the hood. So it is interesting that they're taking a closer look, because the concerns that you hear from merchants are, and it generally depends on the size of the merchant. If you have a new product and you just want exposure, Amazon is amazing for you. You can introduce it to hundreds of millions of shoppers around the world far better than you could on your own, and far more cost effectively. But as those sales grow, and if you're not such a prominent brand that you really own the customers, they're looking for your brand, but you just have a product that seems to strike a chord and is growing, Amazon has visibility into those sales, and we have seen examples of them actually mimicking products that some of their third-party merchants were already selling on the platform. So to that extent, it's going to be interesting to see if the EU can come up with them having any kind of advantage. And that being said, it is not that different from, say, Walmart or Target, that have their own private label things and have visibility into the big CPG brands that are selling. They have that visibility, but Amazon just has that broader scope of inventory, and also that more granular level of visibility into not just the things people buy, but the things that they look at, the things they're searching for, and very importantly, the things they're searching for and not finding.
Darren, do you think customers, there's been this sort of shift towards, the importance of privacy, and it's kind of a super trend, if you will. Do you think that these privacy concerns could actually impact behavior on Amazon?
I think it's always going to be a balance with customers, right? I think they're going to want that data privacy, but at the same time, if that impacts the friction that is in the shopping experience and makes it harder to actually get the right product easily, then that's not going to be viewed well at all. So I think it's always going to be a balance, and what retailers, as big as Amazon or smaller e-commerce retailers, need to do is constantly look at the data to understand and test those trends.
So, Spencer, where do you see Amazon's ad business going? What are the projections?
Well, I think I've seen projections as high as 20 billion, 25 billion. It's just going to keep growing, especially as it keeps adding more and more inventory, getting into more and more products. The site gets more and more cluttered, and then it becomes more and more important for you to advertise. So they've really got this kind of carrot and stick approach with merchants. If you don't put your product on Amazon, they might try to make their own private label. If you do put your product on Amazon, then you've got to advertise it to differentiate from all the other folks on there. And even if you advertise your product, you have to advertise aggressively so that someone else doesn't sweep in and take that keyword from you. So it's really a sweet spot that they're in, since they have so many customers. And it's also a very profitable place, because they can build this on their own platform without having to invest a tremendous amount of money like they had to do with all of their warehouses for their e-commerce business and all the data centers for their cloud business. This is kind of a low investment revenue opportunity for them.
Darren, you're smiling and nodding. It's like rock, hard place, Amazon on both sides.
I would not want to be a brand manager at a CPG company right now, because I think you are in between a rock and a hard place. And I think what you'll see in the future is the same way that an ecosystem of companies sprung up around Google search when it started to dominate people's online behavior. I think you're going to see the same thing for Amazon search. So what people are going to need is non-Amazon sources of information that help them understand what they're supposed to do and how they're supposed to spend their advertising dollars.
All right, Darren Baker, CEO of JumpShot. Great to have you back on the show. Spencer Soper, as always, for us in Seattle.
Thanks, Emily.
When we come back, researchers and futurists may be sounding the alarm on artificial intelligence, but what about using AI today to make some money? We will talk to an expert from Morgan Stanley. That's next. This is Bloomberg. Alphabet has thrown its backing behind GitLab, a platform for sharing and collaborating on code. GitLab says it raised $100 million in its latest round of funding, which values the startup at just over $1 billion and makes it the latest unicorn in the booming market for digital operations management. GitLab's customers include Intel, Alibaba, and NASDAQ, and says it saw a surge of users after Microsoft bought rival GitHub in June. Well, artificial intelligence is everywhere, in our cars, our phones, now even our wealth management. Those in the industry say AI tools are a complete game changer, allowing for better synergy between wealth managers and clients. But what does the future really look like? And will AI technology mean less jobs for wealth managers or just change the way they do business? Here to discuss, Jeff McMillan, Managing Director and Chief Analytics and Data Officer for Morgan Stanley. You're in town to speak at an AI conference, in fact. So what is Morgan Stanley's vision of the implementation of AI?
So first of all, I think you have to start with what we believe the value proposition for financial advice is, and that's a trusted relationship between financial advisors and their clients. And we've done extensive analysis, and even in 2018, people still want to talk to their financial advisor. It's actually, engagement is the number one driver of outcomes. So the question really becomes, how do we make that financial advisor better at what they do? How do we augment their processes and their capabilities to deliver the best advice to every single advisor in their book in a really scalable and efficient way? And artificial intelligence does specific things that are very unique to technology that really help advisors do that in a very, very differentiated way.
So then how does the rise of AI impact hiring? Do you need to hire less financial advisors in the future? Is there more revenue per advisor that you have?
So I would say that AI, first of all, makes us have to hire more data scientists. That's number one, and there's obviously terrific opportunities. But we just fundamentally disagree with the proposition that humans are going to go away as a result of the technology. And I think that this concept of comparing the human versus the machine, it's just a flawed choice. Humans do things that ultimately humans do in really powerful ways, and technology does things in very technical and capable ways. And the question is, how do you marry those two things together? And again, going back to the value proposition, our advisors, when they're talking with their clients, is where we add values. And the more we can do that, the more value we're going to create. And this is about creating better synergies between those relationships as opposed to trying to eliminate all human thought from the process.
But even if you're hiring more data scientists, does that mean you're hiring more financial advisors as well, or less?
I think I mean, listen, I don't know what the future is in terms of the actual numbers. I think the real focus is not whether we hire more financial advisors. Our focus right now is how do we get our advisors to deliver the best advice to their clients, and we think that that's a long-term value proposition.
What are the biggest risks in using AI? Not the least of which is security.
Well, listen, I think people are ultimately concerned about the transparency of the decision making, right? And I think these algorithms do a lot of math behind the scenes, and I think what we have found is that it's equally important not just to deliver good ideas, but it's also important to deliver the transparency on why those ideas are delivered to the financial advisor and giving them the reasoning behind it as opposed to just sort of presenting them a bunch of data points that says, here's what you should talk about today.
So, based on your research so far, will we see better returns as a result of AI, and how much better?
Well, listen, we can't predict future returns. I think that's a very difficult thing to do in the marketplace. But I think
AI has been around now for
AI has been around a long time. And listen, I think it's also important to sort of talk about where AI has limitations, right? You know, part of the challenge of machine learning and artificial intelligence is it's as good as the predictive value of the historical data you have. And much of what investing is about identifying secular trends in the marketplace. And if it hasn't happened in the past, the technology is actually not going to pick that up and not going to predict it, which is why the investment process still is going to require people to come to work in the morning and talk about what's going on in the markets and think ahead.
So how is the way Morgan Stanley is doing it better than the way Betterment is doing it, or Wealthfront?
Well, so first of all, advice and investing is just one part of the equation. You know, what we're trying to do is deliver the full services of ideas and investment capital, and that includes talking to clients about dealing with parents with early stage dementia and figuring out when their child turns 16 and offering them help around opportunities to insurance opportunities and safe driver courses and things like that. Like, we're about the entire investment process. And if you think about what a financial advisor does, is they come into work in the morning and they ask the fundamental question, who do I engage today and what do I engage about? We have millions of things that are happening in the marketplace every single day. And what the AI allows us to do is, number one, figure out and help the advisor figure out what best to engage that client on. And number two, using machine learning, figure out what the client's responding to. Everybody is different. This is not about offering you something similar to people that look and feel like you in a certain zip code. This is about delivering advice for you. And the technology really allows us to scale those opportunities in a very, very differentiated way that we've never been able to do before.
There's been a trend towards fee compression. Will fees go down as a result of it?
Listen, I think if we can continue to offer value to our clients, right? Which is really the ultimate question. I actually don't believe that to be true. I think that as long as we're offering differentiated advice that clients value, I think they're going to continue to come to us. And I think like this whole concept that we're trying to compete with a machine, we're just trying to make people better at what they do and continue to engage clients around these complex issues. And to be clear, the AI is very, very far away from being able to talk to you about what to do with a child that was just born with autism, right? Those are very, very unique situations, and that's so much of what the financial advisor is delivering to their clients today.
So when do you see a mass adoption from a client's perspective?
Well, we already, I mean, our financial advisors, we've deployed our alternative investment, or our artificial intelligence platform to our 16,000 financial advisors. We've been at it for 6 months, and they're at it every single day. Adoption rates are really, really high because they see it as an augmentation to their business, not a replication of it.
All right, Jeff McMillan, Chief Analytics and Data Officer at Morgan Stanley. Thank you so much for stopping by.
Thanks, Emily.
Great to have you. All right, one-stop wedding registry site Zola makes wedding planning easy, but getting Zola started wasn't quite so simple. Co-founder Shanlin Ma tells us about the trials of fundraising next. This is Bloomberg. When Shanlin Ma first began pitching her online wedding site Zola, she says 3 out of 4 investors turned her down. The one-stop wedding registration site didn't immediately resonate with most venture capitalists, a male-dominated field. Today, Zola has raised more than $140 million and has expanded its offerings to over 60,000 products and experiences. It even includes services beyond gift registry, including guest list management and website creation. She sat down with Bloomberg star Scarlett Fu at the monthly Cornell Tech at Bloomberg event to tell us how she got there.
Fundraising is never the most fun part of starting a startup, particularly if it is a product where you are pitching a product that is primarily serving a female audience, and you are pitching it to a VC industry that is primarily male. They, for the most part, got married 15 to 20 years ago. And even then, they didn't really do much of the wedding planning work.
Wait, they told you this? They would tell you this straight up?
Yes, I did certainly hear VCs say, you know, I got married 20 years ago and my wife seemed fine with the registry, so what's the problem? Yeah, I don't understand. But those were not the VCs that we ultimately had invest in Zola. Because it was harder to show that emotional connection to the problem and how the product solved this better than anything else, we focused on how is this business model innovating, how are we redoing retail, and we had the numbers to show it, and they absolutely got it.
Okay, so talk to us about some of the numbers, because I was taken aback by how big or how valuable the wedding industry is in the US and then globally.
Yeah. It is a $100 billion industry in the US, and globally it's a $300 billion industry. And when you think about it, weddings is one of the few industries remaining where we haven't seen a dominant startup player or disruptor emerge to take the market. Zola right now is the best placed company to be that disruptor, and we will do that.
And people spend how much for a wedding on average?
So on average in the country, it's $35,000. We all are in New York. The average is a little higher for a wedding. Here, it's about $75,000.
And still climbing. All right. So when you talk to these VC guys who didn't quite get it and said, oh, but this wasn't a problem 20 years ago. My wife dealt with this, or my partner dealt with this. This becomes something that becomes problematic when you're a woman pitching a woman-centric concept. What's your advice to female founders who run up against this problem? Because let's face it, most of the investors out there are going to be men.
My number one piece of advice here is that it's never personal, so don't take it personally. Pitch, get the feedback, do your best, and keep going. And what I found is that in the early days, I would get very emotionally invested in every single no, when the reality is that there's so many other reasons why an investor might not invest in your company apart from you or the team or the idea. It might have to do with where their firm is. It might have to do with their position in their team right now. It might be that they just invested in a competitor. There's so many reasons. And so it's just a matter of how can you find, really just need a few people who have a very shared vision and people that you think will be the right partners for your business. And that part of the equation is just as important as getting a term sheet. And when you have that, that is one of the best, most impactful things you can do for your business.
That was Zola co-founder Shanlin Ma speaking with Bloomberg's Scarlett Fu at the monthly Cornell Tech at Bloomberg event. And that does it for this edition of Bloomberg Technology. Tomorrow on the show, do not miss our interview with Gap CEO Art Peck, a wide-ranging conversation exploring the future of retail. That's tomorrow. I'm Emily Chang. This is Bloomberg.